Welcome to the Currency of Knowledge, a County National Bank wealth management podcast, the podcast where we unravel the layers of prosperity, explore the diverse meanings of wealth, and delve into the stories of those who have built their own versions of abundance. I'm your co-host, Christopher Phillips.
And I'm Holleigh Baker. Join us on this insightful journey as we redefine wealth beyond the balance sheets and uncover the true riches that life has to offer. Let's explore the essence of wealth in all its forms. We are back for another episode of the Currency of Knowledge, our educational series. As you can see, I'm missing my co-host today, so it's just going to be me and Austin Jenkins. He is from DFA, Dimensional Fund Advisors. We work with DFA. They help us put together our portfolios. Austin is the regional director of Dimensional's Bank and Trust, and he has responsibilities on a national and regional bank level. So he helps us, along with credit unions and other trust companies, to educate our investment professionals on investment philosophy, capital market research, and practice management insights. Austin has several years of experience in this field, not only with Dimensional, but with other institutions. And he not only graduated, I believe, cum laude or maybe summa cum laude from the University of Ohio. He also has a CFP designation. So we are excited to have Austin with us today. We'll do a two-part series with him. The first part, which will be the diversification done right and building the right portfolios and exploring asset allocation and asset classes. And then we'll be talking to Austin about ethical and sustainable investing, so ESG, which is a hot topic over the past few years. So looking forward to these two great podcast, so to speak, an educational series with Austin. Well, Austin, thank you for joining us. I think we did the intro, and Austin is from our partners with Dimensional, so DFA. Very excited to have you here with us today.
Very excited to be here. This is awesome.
Yeah, we're going to cover some investment questions that I'm really thrilled to have you provide your expertise to us on. So we are going to jump right into portfolio diversification and asset classes and allocation, which is an area that we get a lot of questions on from our clients and then, of course, just friends and family. So right into it, what is diversification in a portfolio?
Yeah, diversification is one of those critical concepts, kind of a foundational concept of investing. And when you think about it, I like analogies or pictures or whatnot. You have a bunch of buckets with water in the buckets. If something comes up, one of those buckets falls over, you're okay if it's spread across multiple buckets. But if you're in one bucket, it can be some issues. And that's what diversification really is at the highest level. It's about allocating your capital to different asset classes or different investment types that over the long haul, the hope is that having multiple investments is going to help smooth out the ride for you.
Okay. So not just one bucket. You said it tips over, we've got a problem, which leads me to believe that diversification is pretty important. Very,
very important, yes. But in investing, they say diversification is the only free lunch that you really get. So it's one of those critical concepts. If you think about the investment journey, all of us would like this really smooth, steady ride to get to our investment goals. But anyone that's invested or in the investment industry knows that that's not typically the case at all. It's ups and downs. But what we can find in diversification is it helps to smooth out that ride to get you to your goals. So the risks that might be associated with any individual asset class or type of investment tend to be never eliminated, but significantly decreased in the volatility if you have a nice round diversified asset class in your financial plan.
So the more diversification I have, perhaps the less down I'm going to feel.
Yeah, typically. Yeah, that's absolutely could be the case. Now, there's no certainty in the markets. We know that as we've all experienced in the last few years, but it definitely helps smooth out that ride for you to get to where you need to be eventually.
Okay. And as far as from a diversification standpoint, I've also heard people talk to us about asset classes.
Yes.
What is an asset class?
Yeah. So there are many different types of asset classes. I'm going to keep it as high level as possible. But stocks, bonds, cash, real estate, just to name a few. So what are stocks? Stocks represent some sort of equity ownership in a company. You're taking your capital and purchasing shares in a company in hopes that you get some future benefit from them, some cash flow or appreciation.
Yeah.
Bonds, different asset class. So that's, think about it just high level as a loan that a company is loaning to you.
Okay.
You're getting a set steady payment from them. Real estate is another one. So that can be physical ownership of real estate, like most of us in our homes, or even investment properties as well. Okay. And then there's asset classes like cash, which are really thought of as liquidity instruments, short-term solutions, things like money market accounts and stuff like that help us over the very short term. So lots of different types of asset classes there.
Okay. Do the asset classes or the different asset classes help me in any way with the risk?
Yes. So one thing to think about is the correlation between asset classes. So what that means is how do they behave with one another? Okay. So diversification in asset classes, what we generally see, I'm going to speak generally in the podcast here, but when we think about stocks and bonds, for instance, they tend to be less correlated. It's not zero, it's not negative, it's not inverse, but they tend to be less correlated. So what that means is they don't move in lockstep with one another. The prices, the market environment doesn't move in lockstep. So that's good for investors, because what that means for us is that there is a benefit to having some sort of mix between the two potentially in our portfolios that helps to mitigate downside risk in our portfolios.
Okay. So if my stocks are up, does that mean my bonds are down?
Not necessarily, but it can in some situations. So what we tend to see is stocks and bonds behave differently in different environments. So if we think about in periods where we're seeing economic growth, for instance, that's generally when we see equity stocks doing better than bonds. But bonds can really act as a ballast to investment portfolios. And what I mean by that is exactly what we were talking about earlier with diversification. They help to balance out that ride where you're going to see stocks generally going to be a little bit more volatile than bonds.
So bonds make my portfolio a little less risky potentially?
Yeah, absolutely. Yeah, it all depends on the portfolio that you're in, your circumstances, but we really like to think of bonds as serving as there's many different financial goals that they can accomplish: capital preservation, income distribution, all that type of stuff. But one thing is for certain, they can help balance out the portfolio for you.
Okay. And then the risk return profile for each asset class.
Yes.
Can you hit on that a little?
Yeah, it's a very good question, because if we think about it in the most simplistic of terms, we as investors want to be compensated for the risk which we're taking. Mm-hmm. That's the reason why we're putting money into these instruments. So when we think about it, equities tend to be more volatile in nature. They tend to be riskier in nature, but that's because they tend to have higher expected returns over the long term. So more risk, more reward.
Okay.
Pretty foundational concept in nearly everything in our lives.
Absolutely.
Applies the same thing in asset classes. Bonds tend to be a little less risky, maybe moderate risk, some would say moderate returns. Now, what is important to note is that's generally speaking, within each of those, there are many different subsets of stocks and bonds that we can dive into that have different risk profiles as well. But generally speaking, equities present the most growth upside in the portfolio. Bonds tend to be more of the ballast to the portfolio. It's a little bit less risk, less return there associated with them.
So you kind of touched on it, but so based on the type of stock or the asset class maybe of stock, if I heard you correctly, it may be more risky than another. So maybe is large cap more risky than small, or how does that work?
Right, yeah, so there are different types within the United States. We can think about geographically, we can think about different sectors, for instance. So, within the U.S., what we would generally expect is small caps tend to be a little bit riskier than large caps. You can think about that as, if you're a mom and pop shop versus a large retailer and you go to get a loan, who's going to have the higher interest rate? It's going to be this mom and pop shop. So they tend to have higher risk associated with them, higher returns associated with them on the over the long term as well. We can apply that across geographies as well. You can think about like emerging markets. So outside of the United States, those economies tend to be a little bit riskier, some would say, to invest in. So you would expect to be compensated for that risk. So there's different risk profiles within all of them.
And we take all of that into consideration when building the portfolio.
Absolutely. We want to use all the available information to us when we're constructing portfolios, because what we really want to do is build a portfolio that for the investors they can stick with in the long run. That is the absolute most critical mission for all of us, is to build portfolios that are financially sound, that'll help us achieve our goals over the long run.
Okay. And when you say long run, what is long term?
Yes, long term means a lot of different things to a lot of different people. Yes. So, generally speaking, the industry will throw out like a 10-year plus time horizon. So time horizon is another really critical factor when we think about asset classes in our financial plan, because the reality is we all probably have multiple different goals. We have short-term goals, we have intermediate-term goals, we have long-term goals. So we want to design our portfolios that help accomplish all different types of goals. We might have some buckets of solutions that are geared towards long-term aspects like retirement or philanthropy or distributing money down to generations. We can have short-term goals that are also really important that might have a different investment focus associated with them.
Okay. And we would pick the asset class or the type accordingly.
Yes, absolutely. Yeah. So to give you a realistic example, I am in the market for a home. We're actually under contract, which is really exciting.
That's great.
Yeah, it's fantastic. So I'm not going to put the money that I'm expected to use as a down payment in the stock market.
Okay.
I want the volatility not to be associated with that. So that's going to be in short-term bucket like cash.
Makes sense.
Yep.
So some principal preservation.
Right. Yep.
For
Absolutely.
the big investment.
Yep.
How exciting.
Yes.
Good for you.
Yeah, thank you.
How are the asset classes correlated with each other, which I think you kind of touched on a little bit?
Yes. Yeah. So there is correlation between asset classes. They're not perfectly correlated, which is what presents us with diversification benefits. Some asset classes are more correlated than others. There are, within, if you think about equities, international within U.S. and emerging markets, there are going to be a higher correlation than maybe, let's say, fixed income to equities in general. So what we're really looking for in those correlations is really just to build a sound portfolio that is designed to not get us in trouble when things get murky in the waters, which ultimately could happen. So correlations depend on which asset classes you're looking at, but they're not perfectly correlated, which is good for us investors.
Yeah, great. And my risk tolerance, or how likely I am to handle the decline in the market, which we do understand typically comes back, or always comes back, I guess. How does my risk tolerance or my concern guide my overall portfolio? Yeah, there are many different factors that are going to go into the risk tolerance or just the construction of the portfolio in general. One being your time horizon. That could be how long I have. Exactly, how long you have to achieve your goals. For folks who are very young investors, maybe they can have more risk appetite than other folks. So maybe that's going to change their personal risk profile. But there are other things too, like just appetite in general. How risk adverse are we as humans? And that is a deeper question that we can explore a little bit more. But I think all those things really go into culminating of, okay, what makes sense for my personal situation, which is exactly why folks at County National Bank, folks like yourself, are so critical in this financial journey. Yeah, to make sure. I mean, we hear it a lot from, I've had clients say, I don't worry about it. Yeah. But then when I ask the question, okay, so when the market goes down 10 to 20%, how are you feeling about that? Yeah. Are you watching it every day? Are you one that logs in every day and you're happy when it's up, but it's down some? And so that is interesting to pull out of people to hear Because most people are not as risk adverse as they might think.
Yeah, exactly. And I think that's one of the most critical points of the financial journey is understanding your circumstances, your situation, your goals, and understanding what appropriate investments or risk tolerance or risk profile makes sense for you all. Because in reality, we're all humans. We all have emotions, and that's definitely going to play a role in the financial journey process.
Can I sleep at night?
Yes, exactly. Right.
So should I have alternatives? Cryptocurrency is such a huge thing these days.
Yeah. So it's an interesting topic of conversation that we could probably spend an hour on. And when we think about these alternative asset classes, one thing's for certain, they're getting a lot of interest in terms of marketing dollars that are being spent across the industry, commercials all over the board. But really, when at Dimensional and what we think about, when we incorporate anything into the investment profile, does it serve one of two purposes? Either is it going to increase our returns, our expected returns, or is it going to help us to control risks associated in our portfolio? Those are the two primary considerations when we're looking to build out investment solutions. And I think the jury's still out in terms of cryptocurrency and its real value add. You can think about your typical asset classes like stocks, equities we just talked about. We know that they are going to increase our expected return. We know that there's some benefit that's being derived from them. Cryptocurrencies, we're still kind of trying to figure out, I think, where the value truly comes from. Is it just speculation, or is there something underpinning it? So what we would say is your foundational building block of your portfolio can be accomplished in very traditional asset classes. That's not to say that folks cannot have cryptocurrencies or alternatives in their investment experience, but we would say consult with your financial professionals and build out an appropriate risk tolerance that makes sense for you.
Yeah. So you're not chasing a trend.
No.
So, and I'm not necessarily saying that cryptocurrency is a trend.
Right.
But that's what we're not chasing that.
Right.
The flashy thing.
Right. We want to rely on what has been long-term drivers of wealth generation for folks. And the traditional asset classes have done a tremendous job at helping build wealth over generations.
How does cash or cash equivalents play a part in that?
Yeah. So it's an interesting concept because I think it kind of alludes to this phenomenon where people try to time markets or try to get in and out of cash and into investments and stuff like that. We would say, generally speaking, cash and cash equivalents tend to be a very short-term bucket for folks for immediate liquidity needs.
Okay.
So if you're buying a house or if you're a car or tuition or something's coming due, you want to have a bucket that will take care of those needs for you. Now, what you don't want to do is extrapolate that out over your entire portfolio where you could be potentially jeopardizing the long-term returns associated with stocks and bonds. So what I mean by that is trying to time when to be in and out of those and maybe moving into cash. It's a really, it sounds great. It's very enticing for us to do. But the reality is nearly 100 years of data in the financial industry has proven that it's very difficult and almost impossible to time markets. And, unless you're very, very lucky, a better strategy to maintaining your wealth and growing your wealth is to stay a disciplined investor throughout time.
I think you have a chart that I use or a graph that talks about time in the market, not timing the market, which is a great graph.
Yes, there are, if anyone's interested, reach out to the County National team and they'll be happy to show you that graph. But, even missing some of, let's say the best day in the market or the 5 best days in the market over a long time horizon tends to be really bad for wealth. I mean, it can dramatically reduce the total wealth that you generate as opposed to if you just left it in there.
It is quite amazing.
Yeah.
I have said to clients, though, if I could time the market, I would be on a beach.
Yeah,
someplace
none of
warm.
us. Yeah,
I mean, I love my clients,
Right,
but I
right.
would be someplace warm.
That's right. Totally.
Should there be any geographical considerations when I'm building this portfolio?
There can be, yeah, absolutely. I think just speaking high level, us in the U.S., the U.S. makes up roughly 65% of the investable universe, which is a lot,
Yes.
but that still means there's 40% that's outside the United States as well. Generally speaking, we tend to see people have a home bias in their portfolios, but what's important to note is the U.S. is rarely the best performing market across the world. There's a lot of variance in returns across countries. So we believe that there's a very critical case for having global diversification, exposure to stocks outside the U.S., because the reality is none of us know when and how markets are going to behave. So we want to be positioned to capture returns when and where they do show up.
Okay. And kind of following up on that, so as I'm looking across the geographical footprint, so to speak, should I be changing my allocation or my investment strategy based on the geopolitical or however the wind's blowing that day?
Yeah, no. I would say, generally speaking, that tends to be a loser's game, a loser's proposition, and chasing returns or trying to time or untime, the markets. I would say the market is really, really efficient at pricing in information quickly, when there's any sort of disturbance. So maintaining that proper diversification, geographic exposure, we think is important. However, there is a case to be made for having active implementation within, if you're getting access to those countries. So just having a manager, an asset manager, someone like Dimensional Fund Advisors who can be actively analyzing and evaluating risks inside markets is very critical to the process as well.
So from a psychological standpoint, and it is so easy to watch it on TV and, they are yelling at you about get out or whatever they're doing. How are we managing? How are you helping us help our clients also manage just the psychological aspect of not jumping in and out?
Right. Yeah. This is the $1 million question. I think this is really where the value of a financial professional is demonstrated across the board, because even myself, as what I would say is an educated investor, even I fall victim to tuning on the news and hearing, my friends or someone talk about something. So just understanding the long-term implications, I think, is really like the baseline for all of this. We have a phrase at Dimensional, it's called tuning out the noise. There's a lot of noise that occurs in the financial journey as investors. So the more that we can focus on our long-term goals, the better off we are. And what I would say is the most important thing to ask when these situations are occurring with markets are acting up or whatnot is, has my financial plan, my financial goals changed? If the answer to that is no, then you're probably okay. If the answer to that is, maybe my financial goals have changed, then maybe it makes sense to revisit or analyze the portfolio. But generally speaking, being a long-term investor, kicking your feet up, putting on the headphones, tuning out the noise tends to be a great way for folks to build wealth over the long term.
I love that. And you had commented about long-term investing. So that's not just the reaction piece of it, and have my long-term goals changed, goals being different, changing from just what's happening every day in the market. So thank you for sitting down with us. We love the partnership with DFA and all that you do for us. So love the fact that you're in the studio with us. Thank you.
Very excited to be here. Thank you.
Securities and insurance products are not FDIC insured, not being guaranteed, subject to investment risk, may lose value.